2 years ago, Port St. Lucie was Florida's retirement dream. Safe, affordable homes at $225,000, mortgages under 4%, and insurance you could cover with a single Social Security check. Today, that dream is collapsing. Median prices shot past $400,000, but now inventory is up 60%. Homes sit unsold, and retirees face insurance bills topping $8,000, if they can even find coverage at all. Fixed incomes are no match for these runaway costs, and families who flocked here for paradise are suddenly trapped in a market unraveling at record speed. So how did Port St. Lucie become the epicenter of Florida's housing implosion? And who's paying the ultimate price? Port St. Lucie sits just north of South Florida's chaos, a city built on the promise of sun, safety, and affordability. In 2019, that promise felt real. The median home price hovered between $225,000 and $245,000, low enough for a retired school teacher or postal worker to buy with confidence. 30-year mortgage rates floated between 3.7% and 4.2%, keeping monthly payments within reach, even for those living on a fixed income. Insurance premiums, rarely more than $1,800 a year, fit neatly into a Social Security check. On quiet streets lined with palms, the average home spent just 30 to 45 days on the market. Realtors described a steady, predictable rhythm. Buyers, mostly over 55, relocating from colder states or crowded cities, drawn by the chance to stretch their pensions without sacrificing comfort. The city's median age, 47, stood well above the state average. Nearly 3 in 10 households depended on Social Security as their main source of income, and for many, that check made up over a third of their monthly budget. Port St. Lucie was pitched as the antidote to Miami's sticker shock and the hurricane premiums of coastal towns. Here, retirees could find a modest ranch or a tidy condo minutes from the beach, but outside the flood zones that sent insurance costs soaring elsewhere. The pace was measured, the growth steady. Local agents called it Florida's best-kept secret, a haven where a fixed income could buy not just shelter, but peace of mind. For a generation who spent decades saving, it seemed like the perfect place to finish the story. That foundation would soon be tested by forces no one saw coming. By the spring of 2020, Port St. Lucie's quiet rhythm gave way to a frenzy. Remote workers from New York, Boston, and Miami, newly liberated from office towers, arrived with urgency and cash. Listings drew 15, sometimes 20 offers within hours. Bidding wars became routine. Buyers waived inspections, wired deposits sight unseen, and pushed prices from $245,000 to over $400,000 in less than 2 years. Agents fielded calls from out-of-county numbers. By mid-2022, more than a third of buyers came from outside St. Lucie, many paying above asking, many with no plans to ever visit before closing. Builders scrambled to keep up. Lennar, D.R. Horton, and GL Homes doubled, then tripled their permit applications. Age-restricted communities rose from empty lots, with homes reserved months before the first slab was poured. Some projects sold out before the model homes opened their doors. Construction sites buzzed day and night, fueled by the belief that demand would never slow. Permits for new homes ran 2 to 3 times above the city's historic average, and buyers lined up for the chance to claim a spot. Institutional investors joined the stampede. Funds like Invitation Homes and Open Door accounted for a quarter of all transactions in 2021 and 2022, outbidding locals and snapping up entire blocks for rentals. Inventory shrank to less than a month's supply, the lowest on record. For a moment, it seemed Port St. Lucie had become immune to downturns. Local agents called the market crash-proof, a safe bet in uncertain times. Behind the optimism, the city was being reshaped by forces moving too fast to control: speculative money, relentless construction, and a flood of newcomers chasing the same dream. The seeds of oversupply and imbalance were sown in the rush. Insurance premiums in Port St. Lucie began their relentless climb in 2021, but by 2025, the numbers defied belief. The average annual policy, once a manageable $1,800, now lands between $6,500 and $9,500, sometimes even higher for homes with older roofs or minimal wind mitigation. For retirees, these bills arrive with the weight of a second mortgage, devouring fixed incomes and upending budgets built on decades of careful planning. The private insurance market has all but vanished. State Farm and Farmers, two of the largest carriers, announced their exits in quick succession, leaving tens of thousands scrambling for coverage. Each departure triggered a wave of emergency re-quotes, policy cancellations, and frantic calls to agents who could offer little hope. In many cases, policies were denied or withdrawn after roof inspections, sometimes for nothing more than a roof older than 15 years. Hurricane Ian's aftermath only deepened the crisis, as insurers recalculated risk and raised deductibles, making even newer homes expensive to cover. Into the vacuum stepped Citizens Property Insurance, the state's last resort carrier. By early 2025, Citizens covered nearly 40% of all homes in Port St. Lucie. But Citizens is no safety net. Its rates, often higher than private options, come with strict coverage limits and warnings from board minutes about possible insolvency if claim volume continues to rise. Internal memos describe contingency plans and actuarial models that hint at a system stretched to the breaking point. The fallout is immediate and brutal. Nearly a quarter of pending real estate deals now collapse over insurance costs alone. MLS logs are filled with listings marked "back on market," insurance issues. For buyers, a quote can double between contract and closing, wiping out savings or forcing them to walk away. Sellers, many of them retirees counting on a sale to fund their next move, are left stranded. The insurance crisis doesn't just raise costs. It freezes the market, traps homeowners, and dismantles the financial security that brought so many here in the first place. Mortgage rates, long a quiet ally for Port St. Lucie's retirees, turned hostile almost overnight. In 2021, a 30-year fixed mortgage hovered at 3%, enough to keep payments predictable, even as prices soared. By 2025, that rate has more than doubled. A $300,000 home now demands a monthly payment that's $560 higher than just 4 years ago. For buyers relying on pensions or Social Security, the math no longer works. Loan officers across the city report a steady stream of failed pre-approvals. Debt-to-income ratios that once passed with room to spare now trigger instant denials. FHA and VA loans, lifelines for many older buyers, are falling through at closing, victims of underwriting rules that don't bend for fixed incomes. The pain isn't limited to new arrivals. Many who bought at the peak, convinced by agents that rates would stay low forever, now find themselves unable to refinance or sell. Falling values have erased equity gains from the boom. Thousands are underwater, owing more than their homes are worth. For sellers, each failed contract brings another month of insurance bills and property taxes, another round of price cuts. Lenders have tightened standards, wary of defaults and shrinking collateral. Appraisal gaps of $20,000 or more are common, forcing buyers to bring extra cash to the table or walk away. The result is a market where even motivated buyers are locked out, and longtime owners are trapped by mortgages they can't escape. In Port St. Lucie, the dream of affordable retirement has collided with the reality of a mortgage system recalibrated for risk, not stability. The squeeze is relentless: higher rates, stricter rules, and fewer paths to relief. Retirees who once trusted Port St. Lucie with their final chapter now find themselves cornered by forces well beyond their control. The equity they built, a lifeline meant to carry them through old age, has evaporated almost overnight. For those who bought at the top, the loss is staggering. A home purchased for $400,000 in 2022 now appraises for $50,000 to $80,000 less, erasing years of savings and any hope of passing wealth to the next generation. Adult children, themselves squeezed by rising costs, can only watch as the inheritance they once counted on dissolves into paperwork and mounting bills. Fixed incomes offer little protection. Social Security's annual cost of living adjustments, barely 2 or 3%, shrink against the backdrop of insurance and tax hikes that climb 200% or more. The numbers don't add up, and the gap widens with every renewal notice. Budgets that once allowed for small comforts, dinners out, a cable subscription, an occasional trip, have been pared to the bone. Some retirees skip medication or delay doctor's visits, gambling with their health to cover the basics of homeownership. Even escape is out of reach for many. Medical needs, especially for those managing chronic conditions, tie older residents to local healthcare networks. Transferring care means risking gaps in treatment or losing access to familiar doctors. Medicare plans, often tailored to a specific region, become an anchor rather than a safety net. The very system meant to protect the vulnerable now binds them in place, unable to move even as the ground beneath them gives way. The result is a quiet devastation. For every listing that sits unsold, there is a household silently recalculating its future. The dream of a secure retirement in Port St. Lucie has become a story of shrinking options, lost equity, and families watching as decades of careful planning unravel in the face of relentless, impersonal math. Inventory in Port St. Lucie has climbed to levels not seen in a generation. By mid-2025, the number of unsold homes is up 40 to 60% year over year, with more than 4,500 active listings citywide. Days on market have stretched past 90 for the average property. For sellers, waiting months for a single offer has become routine. Price reductions are the rule, not the exception. Nearly half of all listings have been cut by at least $50,000 from their original ask, and some new builds sit with discounts and incentives that barely move the needle. The glut is most severe in the very communities that once defined Port St. Lucie's appeal. In age-restricted 55-plus developments, inventory now sits at a 6-month supply, far above what agents consider healthy. Entire blocks built for retirees, rows of identical ranches and pastel stucco villas, stand with lockboxes on every door. Resale homes compete with builder leftovers, each slashing prices in a race to attract a shrinking pool of buyers. Homeowners associations, already stretched by insurance hikes and tax shortfalls, have begun imposing special assessments and raising monthly dues by 15 to 25%. Board meetings grow tense as residents protest fees they can no longer afford, but costs keep rising to cover empty units and uncollected dues. Rental vacancies have surged to 10 to 12%, the highest rate in recent memory. Units designed as short-term rentals or investment flips now sit empty, their owners unable to find tenants willing to take on soaring insurance and utility bills. Institutional investors, who once drove up prices, are quietly liquidating 20 to 30% of their portfolios, accepting losses to escape a market that no longer promises easy returns. In some subdivisions, less than 40% of homes are occupied. Streets that buzzed with construction 2 years ago are silent, with for sale signs fading in the sun. The hardest hit zip codes, 34986, 34987, and 34952, show the full extent of the unraveling. Contract failures run as high as 28%, pending sales are down by a third, and every failed closing adds another property to the swelling inventory. The numbers tell a story of collapse measured in unsold homes, abandoned plans, and a community forced to reckon with the aftermath of a boom that went too far, too fast. City council chambers in Port St. Lucie have grown tense the air thick with questions about responsibility. During the boom, officials fast-tracked permits for sprawling subdivisions, green lighting density increases, and approving new phases, even as infrastructure lagged behind. Builders pressed for exemptions, citing urgent demand and campaign contributions that swelled during election cycles. In public records, debates over zoning and stormwater requirements sometimes ended with a nod to expedience. Another rubber stamp, another half-finished road. Critics now point to these decisions as early fault lines, arguing that shortcuts in oversight left neighborhoods exposed to rising insurance risk and overbuilt supply. For residents inside the gates of age-restricted communities, the fallout is immediate and personal. Homeowners associations, already stretched thin by insurance and tax shortfalls, have raised monthly dues by 15 to 25% in just 2 years. Special assessments, once rare, now arrive with regularity. Board minutes show heated meetings, with residents protesting fees that outpace the annual growth of their fixed incomes. Some boards cite emergency repairs or insurance mandates. Others struggle to cover basic maintenance as empty homes pile up and dues go uncollected. The tension is palpable. Those who once relied on stable fees now face mounting bills with no relief in sight. Outside the subdivisions, a quieter shift is underway. For the first time since 2013, unofficial counts from moving companies and address change services suggest more households are leaving Port St. Lucie than arriving. The data is imperfect, lagging behind the lived reality of retirees packing up vans for Georgia or the Carolinas. Conversations with local realtors hint at a pattern. Sellers who once dreamed of downsizing now talk of escape, citing insurance, taxes, and HOA hikes as breaking points. Many who remain are anchored by medical needs or family ties, unable to join the slow exodus. The city's population growth, once its greatest asset, has stalled, leaving behind a demographic profile older, more fixed in place, and more financially strained than at any point in recent memory. In City Hall, blame drifts from one department to another. Officials tout infrastructure spending and point to state-level insurance failures, while residents question the wisdom of rapid permitting and unchecked expansion. The answers are evasive, the accountability diffuse. As the market unravels, the question lingers: who, if anyone, will take responsibility for a crisis that has left so many trapped and so few options for relief? In 2019, Port St. Lucie's median home price stood at $225,000, with insurance averaging just $1,500. By 2025, premiums have soared to $9,500, inventory has climbed over 40%, and prices have dropped by as much as $80,000 from their peak. The data shows that more than 1 in 5 home sales now fail to close, with retirees on fixed incomes facing monthly costs that outpace their Social Security. Over 35% of homes are covered by Citizens Insurance, reflecting a mass exit of private carriers. Yet the total number of households at risk and the long-term impact on local wealth remain unclear, as many official records are still under review. What is certain is that thousands of families have seen their retirement dreams unravel, and billions in equity have been erased. Port St. Lucie stands as a stark case study of a housing market in collapse, with no clear bottom in sight.